AMETK is betting big on aviation maintenance. The recent 8K filing confirms that AMETK has completed the acquisition of First Aviation Services. This isn't just a simple purchase, it is a strategic entry into the MRO sector. MRO stands for maintenance, repair and overhaul, a critical part of the aerospace lifecycle. By integrating this platform, AMETK captures a high-barrier recurring revenue stream that is very sticky. The bull case rests on the fact that aging commercial fleets require constant, specialized upkeep. Simultaneously, defense modernization programs are driving relentless demand for these specific engineered services. AMETK is known for its disciplined capital allocation and its ability to execute bolt-on acquisitions. The addition of proprietary component manufacturing further fortifies their margins through high switching costs. When a company owns the proprietary part, they hold significant pricing power over the end customer. This aligns perfectly with AMETK's playbook of dominating niche, high-margin industrial markets. However, we must look at the antithesis. The 8K filing is surprisingly thin on details. There is no mentioned purchase price, no financing plan, and no clear integration roadmap provided. This lack of transparency can be a red flag for investors seeking a clear valuation. Critics argue that defense-heavy MR revenue is tethered to fickle and volatile government budgets. Furthermore, the shift toward newer, fuel-efficient aircraft could erode the demand for older fleet maintenance. If the industry moves toward platforms that require less intensive maintenance, the growth thesis weakens. There is also the risk of supply chain fragility associated with proprietary manufacturing. Warranty-related liabilities for these components are not quantified in the current filing. Notably, the deal was announced by a senior vice president rather than the CEO. This could suggest the acquisition is a smaller piece of the puzzle, or perhaps less central. Without debt issuance details, we don't know if AMETK is loading its balance sheet with leverage. In a tightening macroeconomic environment, increased debt can quickly become a looming liability. So, how do we synthesize this? The move is strategically sound in terms of market fit. Diversifying into aerospace and defense verticals provides a hedge against other industrial slowdowns. The operational synergies and cross-selling opportunities could accelerate earnings growth significantly. But the gap in the valuation narrative remains until the financial terms are fully disclosed. The ultimate success of this deal depends on the actual cost of the acquisition, and whether recurring revenue can outweigh the volatility of government defense contracting. AMETK has a strong track record, but transparency is key for long-term shareholder confidence. Keep a close eye on the next 10Q for the missing pieces of this puzzle.